Welcome to my channel. In this video we are going to be looking extensively on the smart money concept. I'm sharing with you my strategy in which I use personally, and I'll be sharing with you many aspects including this trade that we have taken, and you are going to see how to cash very high probability entry setups like this in the market. So we are going to be looking at a couple of things. We are going to be looking at demand and supply. We are going to be looking at the differences between supply and demand zones. I mean, other blocks, how they are differentiated. We are going to be looking at the difference between supply and demand zones with other block, right? How to identify and trade high probability setups, how liquidity pools always pull price, how to use the change of character confirmation entry technique, and then we are going to be doing this trade review, right? So this is a complete strategy on its own in which you can adapt if you watch till the end. All right, so if you always like watching videos like this, give me a thumbs up, subscribe to the channel if this is your first time, and see you after the intro.
Okay, traders, welcome to my channel. I am Full Kingsley. By the grace of God, I bring to you guys strategies, tutorials on the forex market, volatility indices, metals like gold, Nasdaq, VIX75, many other instruments. You want to subscribe to the channel by hitting on the subscribe button and notification bell to not miss out.
So this is a trade in which we are currently in. Now we want to talk on what demand and supply zones are, right? So demand and supply zones are simply areas in the market that led to high momentum price movement, right? So whenever you see price move with a lot of momentum in the market, you always leave behind a demand and supply zone or an order block, right? So now we are basically going to be looking at this, especially for trending markets, right? If you see a market that is creating series of lower lows like this, you usually see very strong momentum moves, and price will leave behind demand zones to come back and mitigate these zones. Sometimes price will come back, mitigate these zones, and move down, right? Maybe it creates the next zone and then comes and mitigate and move down. So we basically look at these zones as key levels of entry. This is because we have the institutions, the banks that actually execute their trades, and they will actually wait for price to come back to the zones where they executed the trades to take the remains of the trades, and that's where we are also going to be entering. So we have a similar scenario with an uptrending market. When price creates a very big impulsive move like this, price sometimes will come back, pull back, and then create liquidity, and then post back to a demand zone or post back to an order block before moving, right? And this times we usually wait for price to come back to this area, and then we are going to be taking our buy trades. So in this situation, this will be a demand zone, while in the set side, in the sell side, this will be known to be our supply, right? This will be our supply, and this will be our demand zone, right? So we have this liquidity pools here. So we are going to explain this on our chart. All right, now that is it. Now we want to look at this example, and then we want to also be looking at how to identify these demand and supply zones. Okay, so this is an example of a downtrending market here. So what we want to be considering is momentum. So whenever you see momentum, where you see a very huge bodied candle like this, know that the institutions, the big boys are in play, right? So this will always leave behind an imbalance, right? So when this happens, we look forward a break of structure, because each time you see price create a low and post back, for this downtrend to continue, price will have to continue breaking structure. So at this point, we had this to be the lowest point, and when price breaks structure, it breaks and creates a new low. So when it creates a new low, what we do is we identify these huge bodied candles. This huge body candle now is a sign that only the banks or the big boys have pushed price like this. So in this situation, we know now that okay, it leaves behind what? A supply zone. So in this situation, this is a supply zone here, as you can see, because it is the zone that led to this price movement. So what happened here, the psychology is because the banks actually executed their sell trades, and they don't always execute all of their trades at once. If they want to execute 100 trades, they will only execute 60 or 40 and leave behind and wait for price to pull back to the same zone where they entered before they take their next trade. Remember, they want to be selling at what? At a higher price. You get the point. So at this situation now, we identify the candle, the group of candlesticks that led to that down move, right? And if they are in a box, it tends to be what? Our demand zone. All right, so in this situation, we have this to be sorry, so we have this to be our supply zone. All right, now we talked about something very important. We talked about looking at the difference between supply and demand zone, then with other blocks, right? In this situation, we have this whole zone here where we have groups of candles that can be drawn like in a box to be called what? Our demand zone. All right, this is our demand zone, whereas other block is just a single candle that led to the down move. So any candle that's formed before the first weak candle that was formed before the strong candle that left behind this imbalance is known to be the other block. So the difference is that the other block is this single candle that led to this move, while this complete zone is known to be our demand zone. So that's the difference, right? So now this, in this term, we call this zone the space between this candle, right? The candle that was formed before this big candle and the candle that was formed after this space is known to be what we call the fair value gap or the imbalance. That's what validates that this is a bank move, or this is what validates that the candles before should be our supply zone or it should be our order block, because we have an imbalance. Now this imbalance has created space before, right? We have made videos and we have explained these things in detail. So now, after the imbalance has been created, and then what you simply do is you now identify your demand zone. So once you have identified your demand zone, you mark it out. All right, this is the imbalance. So we have conditions that have been met. We have a break of structure. We have imbalance. Now we also talked about a concept of liquidity. Pulling price, right? So if you look at it very well, you see that price has created what? Equal highs. Price has created kind of a pattern before it gets to that zone there. All right, so if you look at it very well, you are going to see that here we had kind of rejection in which we can use our trend lines to identify. Now you see that we have kind of equal highs, diagonal equal highs, that we can use our trend lines. All right, you see that here we have these highs here. Many retail traders who do not know about this concept will not even pay attention to these zones above. So what they will pay attention is to be selling, because price has rejected once, twice, once, twice, thrice. So they will be selling here. Once they are selling, other people will be buying here, while others are selling, or some will be buying here. So at this point, we consider this zone above to be a liquidity zone. Below here is a liquidity zone, because we will have stop losses of those people that are selling here, and stop losses down below of people who are buying here. So what happened? Liquidity, this zone is known as a liquidity pool. Now this pool will actually pull price, because the banks and the institution, they will know that, and they will move price to break above this zone. And when they break above this zone, what happened? Price will move to the demand zone most likely. So here we see this be a confirmation that liquidity has to be cleared before reaching this zone, and when it is cleared, it will give more fuel for price to be able to sell off when it reaches this zone here, because liquidity is fuel for price movement, right? So it makes the zone more valid. So when we see this, what we are doing is we already place our sell limit order, because we know liquidity has been cleared above here. So this long candlestick here is just to clear liquidity. So we place our sell limit trade here, maybe 50% of this zone, and then our stop loss above this zone here, and then we have our first target somewhere below, and then our second target here, because this zone below here, remember, we have a liquidity pool here that's not yet been cleared. So we know that it's going to pull price subsequently. The banks are always looking for zones of liquidity to move price to, so that they can tap these stop losses, and then price will be able to move. So price has already cleared the buy side liquidity here, and then price has to come back to this sell side liquidity. So that is it. Now price tap to our zone, we enter our stop loss above there, we have our target 1, and then we have our target 2. Remember, as price mitigate this other block here, which is in fact a demand zone, price has to come back here, because there's a liquidity zone below. So that's where our second target will be. So that's how we enter our trade based on. All right, so basically that's what happens. Price gets executed, first target hit, price is moving to a second target, and subsequently price is going to make it to this low below here, because what? Liquidity is actually pulling price, right? That's what we meant at the beginning when we say liquidity pulls zone actually pulls price. So you can see now that price got rejected again here before going up, but you subsequently come back here to mitigate, or to stop out those people that are buying here as retail traders, and then getting together. So basically that is what this strategy is all about, right? So now that is the direct entry. Now we are going backwards again. right? We are saying if you entered based on that. Remember, in our course outline, we say we are going to look at an entry based on change of character confirmation. This is now a 15-minute way of entering, or a 5 minute. So when you come to the H1, you can drop to the 5 minute or the 1 minute time frame. You look at confirmation around this zone before entry. If you do not take this direct entry, because we have just demonstrated the first way of entering, this is it. We drop toward the 5 minutes time frame. Remember, this is the OB that we have identified, which is our demand zone, right, in the H1. I mean, our supply zone in the H1, right? So right now, what we do is we actually drop to a smaller time frame when price reach our key level. All right. So if we replay here, right, at this point in time, we see that price has tapped into that zone here, there. So when price taps into this zone here, what we want to do, we want to look for what we call a change of character, because what happens is at this point in time, price was probably creating highs, right? Creating highs, creating highs, creating highs, until when, if it creates another high, which is the highest point, comes back and break this previous low here, right? It has created a new low. So once it creates a new low, it indicates that there is what, a change of character. Now we'll wait for price to come back and then mitigate any available supply zone, and then we are going to be shorting. That is the confirmation, right? So let's just play out and see how it plays. Okay, right. So if you look at this point in time, in the small time frame, this is the high that has been created, this is the highest point that has been created, right? Okay, so you want price now, because price is creating series of higher highs and higher lows, higher highs and higher lows in smaller time frame. You want price to come and break structure. All right, now you see that price has changed character. Sorry, price needs to come and then change character close below that zone there, which is an indication that it has changed the flow of the market, because at this point in time, price was creating higher highs, right? So in this point, what we do now is we look at the supply zone that has been created at that point in time before price dropped, right? This is the highest point that was created, right? This was the low that led to this highest point. Okay, this low led to this highest point, but price came back and broke, changed character, what we call change of character here. All right, because it has closed below a previous low, which is normally not how supposed to happen, which we usually consider that to be a change in the trend. So in a smaller time frame, we see this to be a change of character. So once there is a change of character and price completely breaks below a zone with this candlestick closing, we wait for price to come back above. Now what we are doing, we are going to mark out what, our various supply zones. This is our supply zone that we have here. Okay, remember, now we are looking for sales because we have had a change of character based on our small time frame. This is a zone that we identify here, which is known to be our, our supply zone. So now we are going to instead sell here. But now if you look at it, we have another confirmation again. Here we have equal highs that have been created before price got to that zone. We have rejection once, twice, thrice. So we had a liquidity pole zone, a liquidity zone here, and price actually cleared liquidity before making to this zone here. So if it clears liquidity before making to this zone, it makes this zone a stronger zone where we are going to be looking for a sell, right? Now we can go ahead and then look for our short, or place our short focus somewhere here, and then we have our stop loss above there. We can have our target, our first target at this previous low here, and then we have our second target maybe somewhere below there. So this change of character confirmation makes you limit your, your risks. Okay, so in this situation we can be selling. Then that is one way. Okay, because we have our confirmation here, price has changed character. Look at that, guys. You see this, price subsequently come and hit our target. All right, now if you look at it again, in the other hand, you can use what we call the Fibonacci retracement tool, where we are going to look at the 0.7 level, 0.6, 0.5 levels, where you drag below, right? And you see that when price comes between this 7 level, 61 level, or 550 level, we are going to be looking. But this 7 level happens to coincide with this. Anyways, we are not going to talk on that because this video was not meant for that, right? So let's just talk about our confirmation based on the order block. This is actually used when there is no order block, when price actually change character and you do not see candlesticks like this that left behind imbalances. That's when we use the Fibonacci. But now that we have imbalances, we can talk about this particular entry technique. So that's why you see that price was able to sell as we forecasted, and right now we have price selling, massively, and it's probably going to make it to those zones that we consider in the higher time frame, right? You see that price keep on selling, and if we just consider that sell setup based on this, you see that our stop loss would have been very minimal, right? Even if you wanted to get a 1 is to 10 weeks to the ratio, we would have gotten a 1 is to 10 weeks to the ratio, because we will have to incur a very small stop loss because we have used what the confirmation. So it's very simple as that, guys. So basically, if you go back to the H1 time frame, you are going to see, remember the change of character confirmation, you can also use the same confirmation in the 1 minute time frame, right? You can use it in the 1 minute time frame if you want to, right? So this is it. So this is basically it. That is when you don't want to use the direct entry. The first demonstration was based on the direct entry, and the second was based on what the change of character. So you can drop to, like I said, you can drop even to the 1 minute time frame. You look at change of character, you ensure that as price create higher highs and higher lows, it should not change character. As soon as it change character, right, you should look for price to come back to the zone. When it comes back now and tap to a demand zone that have been created, or a supply zone that have been created, you are going to be selling. So basically that's how you can use that, right? So I've made some videos in which I've explained these concepts too. Okay, and I'm going to be bringing more videos, more explicit videos, so that you guys can understand better, and you can use this concept in any in any market you are trading, right? So if you found the video helpful, please give me a thumbs up. Make sure that you click on the subscribe button, click on the notification bell, so that anytime we post a new video, you are going to be the first to get a notification, right? So give us a thumb up. Let me know in the comment section below what I have thought. See you in the next video.